Hi all, and welcome to my new video related to Bitcoin education. This is the third lecture related to Bitcoin as monetary value proposition. Let's start. So, as always, as a disclaimer, this presentation is for educational purpose only. It is not a financial advice. Let's start. What does it mean? Sound money and Keynes theory. Under sound money government under sound money, the government should be fiscal responsible without the possibility to increase the money supply, as we have seen in the previous lectures. Fundamental scam of modernity is the idea that government needs to manage money supply. Money supply, in fact, is the problem masquerade as its solution. It functions like a highly addictive and destructive drug. It causes a beautiful high at the beginning, but as soon as the effect subsides, the countdown is devastating, and as the victim begging for more. For Keynes economics, money is what the says it is money. But the fact that gold has been used for thousands of years from before the states were even invented is itself enough refutation of on this theory. Keynes theory begins with the assumption that the most important metrics in determining the state of economy is the level of aggregate spending. Spending incentives producers to create more products, thus employing more workers and reaching full employment equilibrium. A recession are caused by abrupt level of spending. Therefore, it is needed to aggregate spending, increasing the money supply, increasing government spending, or reducing taxes. Reducing taxes is viewed as the least effective method because citizens will not spend all what they save. And Keynes absolutely detested savings. Seeing hard to increase taxes in a recession, the best solution will be increasing the money supply. It will mean also high time preference imposing by the state. And we have also on top of Keynes theory, we had monetary and Austrian schools. Another school is monetarist school, whose intellectual father is Milton Friedman. They oppose Keynesian efforts to spend money to eliminate unemployment. Instead, they prefer tax cuts to stimulate the economy. But for both schools, monetarist and Keynes, a decline in the price level, called deflation, will result in people hoarding their money, reducing their spending, causes increases in unemployment, causing recession. The central bank should be in the business of expanding the money supply at a controlled pace to encourage people to spend more and thus keep the employment level sufficiently low. But by constantly expanding the money supply, central bank's monetary policy makes savings and investment less attractive, and thus encourages people to save and invest less and to spend more, causing also short-termism in artistic and cultural endeavors. This is what monetary school is about. So some difference with the Keynes theory, but similarity in seeing savings, but for the savings will be a role in causing the recession too much savings. But in contrast, we have Austrian schools that, as I said, is in contrast with both schools and focused on establishing an understanding of phenomena in a casual manner and logically deducing implication from demonstrably true axioms. So they prefer to look what happens in the free market, what happens in the market, and finding the rules according to what happened in reality. Austrian school says that money emerges in a market as the most marketable commodity and most stable asset, the one asset whose holders can sell with the most easy, in favorable condition. An asset that holds its value is preferable to an asset that loses value. The asset who hold better its value are the assets are the ones with the highest scarcity, and the quantity of money itself is irrelevant, and that any supply of money is sufficient to run an economy of any size because the currency units are infinitely divisible, and because it is only the purchasing power of money in terms of real goods and services that matters, not its numerical quantity. According to Austria's view, if the money supply is fixed, then economic growth will will cause prices of real goods to drop, allowing people to purchase increasing quantities of goods and services with their money in the future. Such a world would encourage saving and investment for the future, where consumption can happen. This is also important. Increasing savings impact on consumption in any present moment is more than outweighed by the increase in spending caused by the increased savings of the past. I mean, if last year I was saving something for this year I will spend the money that I was saving this year, and this will outweigh the savings I will have this year. A society which constantly defends consumption will actually end up being a society that consumes more in the long run than a low saving society, since the low time preference society invests more, thus producing more income for its members. Even with a larger percentage of their income going to savings, the low time preference society will end up having higher levels of consumption in the long term, in the long run, as well as capital stock. So nonetheless, the society is more towards to saving, but we will spend more because we will spend more in the long run, because in 3 years I will spend what I was saving this year, next year, and in 2 years, and we will have um, they will be more flourishing because of easy savings and investing. Society with money of stable value develop a low time preference, learning to save and think of the future, while societies with high inflation and depreciating economies will develop high time preference as people lose track of the importance of saving on immediate enjoyment. When an economy with appreciating currency would witness investments only in projects that offer a positive real return over the rate of appreciation of money, meaning that only the project expected to increase society capital stock will tend to get funded. In fact, by contrast, an economy with a depreciating currency incentivizes individuals to invest in projects that offer positive returns in terms of the depreciating currency, but negative real returns. The project that beat the inflation but don't offer positive real returns effectively reduce society in capital stock, but are nonetheless a rational alternative for investor because they reduce the capital slower than the depreciating currency. These investments are what Ludwig von Mises terms malinvestment, unprofitable project and investment that only appear profitable during the period of inflation and artificially lowest rate, and whose unprofitability will be exposed as soon as inflation rates drop and interest rates rise, causing the burst part of the boom and bust cycle. Sound money, in making the government fiscally responsible, enforced a measure of honesty and transparency on governments, restricting their rule to within was desirable and tolerable to the population. It allowed the society, it allowed for society-wide honest accounting of cost and benefit of action, as well as the economic responsibility necessary for any organization, individual or living being succeed in life. In fact, consumption must come after production. On the other side, with unsound money, with government increasing the money supply to finance its expenses, the true cost of such scheme is felt by the population in years to come, when inflation of the money supply causes price to rise. At which point the destruction of the value of the currency can be easily blamed on myriad factors, foreigners, banks, of previous governments. Modern voters are unlikely to vote for candidates who are upfront about the cost and the benefit of these schemes. They most likely vote for candidates who promise, we can say, free lunches. In fact, democracy becomes a mass delusion of people attempting to override the rules of economics by voting themselves a free lunch and being manipulated into the violent tantrums against scapegoats whenever the bill for the free lunch arrives via inflation and recessions. So the people are generally voting for people who promise a lot, who expand the money supply, thinking that there are free lunches, but in reality not, because then come the inflation and then come the recession. Anson Money, in fact, has eradicated the notion of trade-off and opportunity cost from the mind of individual of public affairs. It will shock the average citizen to have the startlingly obvious point out to them. All the nice things you want cannot be summoned costless out of thin air by your favorite politician or his opponent. They all need to be provided by real people. People who need to wake up in the morning and spend days and years toiling at giving you what you want. The money that they are printing and are coming from thin air, coming from a cost of real people who wake up in the morning, who work, and who see their purchasing power deteriorating because of inflation. Let's see now the business in a sound and unsound monetary system. In a sound monetary system, any business that survives does so by offering value to society, by receiving a higher revenue for its products than the cost it incurs for its inputs. There can be no profit in a free market without the risk of loss, and failure is always a real possibility and can be costly. Any firms that receive direct government support are effectively zombies and not a productive asset of a society. But the more pernicious method of creating zombies is not through direct government, but through access of low interest rate credit. This is very important. In a free market with sound money, capital owners choose to allocate their capital to the investment that they found most productive, and they can utilize investment banks to manage this allocation process. In a fiat monetary system, the central bank is de facto responsible for the entirely of the credit allocation process. It controls and supervises the banks that allocate capital, set the lending eligibility criteria, and attempts to quantify risk in a mathematical manner that ignores how real-world risk work. In the world of fiat money, having access to the central bank's monetary spigots is more important than serving customers, and this is really a distortion. Firms that can get low interest rate credit to operate will have a persistent advantage over competitors that cannot. So it's an unfair advantage. If we keep going discussing about the business in sound and monitor in sound and unsound monetary system, we go to the last slide of the presentation, and in the we discuss about the following. In a society with sound money, banking is very important and has two key roles: safekeeping of assets and deposit and the matching of maturity risk between investors and investment opportunities. Banks make their money by taking a cut from the profit if they succeed in their job, but make no profit if they fail. Only the successful bankers and banks stay in their job, as those who fail are weeded out. There is, in fact, no distinction between illiquidity and insolvency. Unsound money allows the possibility of mismatching maturity. This is also another very important concept, on which fractional reserve banking is a special case. The central bank is able to create a new money supply and use it to support the bank's liquidity. So there is a distinction between liquidity and solvency. A bank could be solvent in terms of the net present value of its assets, but face a liquidity problem that prevent it from meeting its financial obligation within a certain period of time. But the lack of liquidity itself could trigger a bank run as depositors and lenders seek to get their deposit out of the bank. If the central bank credibly commits to providing liquidity in such cases, there will be no fear of liquidity crisis, which in turn averts the scenario of a bank run and leaves the banking system safe. The presence of the central bank able to bail out the banks creates a major problem of moral hazard for these banks. They can now take excessive risk knowing that the central bank will be inclined to bail them out to avert a systemic crisis. So every liquid problem of bank will be very likely get support of the central bank. So it's meaning the banks are taking excessive risk. And one of the reasons why we had the recession in 2008, it was because of fractional reserve banking, where the banks they took too much risk. While in unsound money, they will take only the risk they're really willing to take, and they know that if they fail, no one will bail them out. That's it for the third part. I think it's very interesting to see which is Keynes, which is the Keynes theory, monetary theory, and Austrian school of economic. I think understanding Bitcoin, understanding Austrian economics is quite hard because it's very counter intuitive. We are used to live in a society where we say the more we spend, the more it's better for the society, but in reality, it's not. And every time a bank or a government, a central bank is printing money, or every time a bank is giving a loan with fractional reserve banking, in reality, they are devaluating our currency, creating inflation, and moving the society to high preference, so more short-term thinking, because we in a society that only spend. While in reality, we should live in a society where the supply of money is as scarce as possible, even better if it is fixed. As I said, it's not important if it is fixed. The total amount, so far it is divisible. With the fixed supply and no central bank, the banks will not take so much risk. They will finance only the projects that they are they should be they will be productive with a lower risk, and with money appreciating in value, we will move to a low time preference society, and we will think more in the long term, and the society will flourish. That's the value proposition of Bitcoin and the Austria School of Economics. I hope you enjoyed, and see you in one of the next videos. Bye.